how you calling yourself, if you do not mind repeating?
Yeah, well, I've self-proclaimed myself to be the official taxman of the Canada Real Estate Investors Club. I know you keep calling me a mentor, but I'm the taxman.
You are the taxman, self-proclaimed, but that's okay. We are approving that with 100%, 1000%. You know that. Okay, so what we are going to cover today, Chris? How you reduces your taxes by 68%? Why not 7 or 80?
Well, there's always ways to increase your taxes or your tax savings a little bit more, but I got maybe one strategy that we're going to focus in on a little bit today, and I'll have lots of tips and tricks and things, of course. So
Okay.
we'll definitely learn something.
Definitely, definitely. I'm always making a notepad and I'm making all the notes, etc. So for everybody else, you do not, we don't mind, and we encourage you to ask any questions. You can ask those questions during the webinar by typing in the question or chat section, or by raising your hand, and I will be very happy to unmute you, and you can ask Mr. Chris directly the question. And that presentation is recorded and will be available only for active Canada Real Estate Investors Club members, and you can go to canadianrei.com and then you can see it, what's the membership about. But our primary goal at today's presentation is to teach you, educate you, help you, and Mr. Chris will be very happy to share his contact information at the end of the presentation. So guys, get ready. Make a notes, sit tight, and watch the presentation. So, Mr. Chris, we are switching to you, and all is yours.
Okay, wonderful. Here we go. Can you see me?
Guys, can you see Mr. Chris? Perfect. I can see it. Can anybody else raise the hand, please? Thank you very much. Yes, we can see you.
Wonderful, great. It's so exciting. Well, thanks so much, Jarek, for introducing me. And it's always such a pleasure to get to speak to members of the Canada REI. And I've gotten to meet so many great members down there over the past years. I know a lot of people often like to start presentations off by giving a little bio of themselves or their background. I was kind of thinking about it, and I kind of feel like bios are they get kind of boring and stale. People
outdated, right?
Yeah, they talk about like, oh, this is my education and how long I've worked here for, and this and that, and I thought maybe I'd show you a couple photos of our office and our team, so you can just get a little bit more familiar with kind of what we're about before I give you some tax tips and things there. So we have well, I'm with Pinnacle Accounting and Finance. I'm the managing partner. Specifically, I head the accounting and tax team here at the office. And there's a couple photos of our office and our reception room here. And I actually I came into the office just a couple days ago. I was like, okay, I'm gonna get a couple photos so that I can share them with the Canada REI there and its members. And so I just kind of surprised some of our staff, like hey guys, put your best smile on. I'm taking your photo. And this is sort of the look I got. So none of them were really prepared to get their photo taken, and I think their facial expressions represent that. But these are a few of the guys in the office here. I'll point out maybe the one gentleman towards the back there in the white. That's Mark. He takes care of all of our U.S. tax filings, our cross-border stuff. The gentleman on the right-hand side of the screen there, closest to the front in sort of the pink shirt, that's Michael. He helps me with a lot of client communications and emails and anybody. I know I have a lot of friends and people we've built relationships with over the years down at the Canada Real Estate Investors Club. So if you ever swapped emails with Michael or something, that's him there in the photo. And if you've been around for a little bit, maybe you've recognized my business partner, Agostino Mosca, and he heads up our corporate finance team. And again, I didn't give him any forewarning. I just sort of showed up in the office ready to take his photo, and so he just looks this good all the time. He was not ready for a photo, and he's just naturally that photogenic, I guess. So that's great. But specifically, when Agostino and I started working together back in 2009, that's when we first started working so closely with Jarek and the members down there, and getting to know everybody. And we did our first presentation in 2010. Jarek, I dug up the old slide deck from back then, and we all looked so young. And of course, back then, when the real estate investment club would get together, it'd be, like a little community room of, 20 people or 30 people. And now, of course, it seems like when Jarek does something, he does it so big, and there's always so many people in attendance. And, just like today, I can see that there's lots of people online. And it's been really fantastic to kind of get to know everybody over the years and take part as Jarek's grown the group, and have gotten to work with people on their tax planning around their real estate, and so on and so forth. And since then, we've had opportunities to give lots of presentations and articles, not just to the Canada REI, but to other organizations and such as well. Like just this past year, I've spoken about business and leadership to some groups here in town. Well-known group, it slips my mind right now. But I've also spoken this year to the University of Calgary, for example. Here's a clipping from an article that I wrote just about a year and a half ago. This was published in NEMA magazine, which is a publication for people who work in the private securities industry. And we wrote an article about tax planning around your real estate and investment holdings. Very relevant. Just this past year here, I was picked up by the Calgary Home Reporter, and I guess I'm wearing something very similar, and I'm in the same room here, so we look the same. But I did a video news segment for them. It actually got distributed across Alberta to every Remax office during their weekly training, so it was very widely distributed. And we did a video segment specifically about tax ramifications on flipping homes and the principal residence exemption, and that was pretty neat. And so I think where I'm going with all of this is I'm trying to let you know that this area that we're talking about tax planning and corporate structures, and specifically around real estate holdings and investment assets, we're really passionate about this, and we care a lot about it, and I find it really interesting, and I'm really excited to share this knowledge with everybody here today, and answer any questions that you might have, or now or in the future. I know a lot of people, whenever we start talking about taxes or the Tax Act and legislation, sometimes they kind of glaze over a little bit. It can get so complicated and detailed, and there's so many moving parts, because you have the Income Tax Act, and you have you have different case laws with the Supreme Court and the Tax Court of Canada. There's CRA publications and income tax bulletins, and there's just so much information out there that I mean, it's one thing to kind of go through the information and learn it all, and then it's another thing to digest it in a way that can really save us tax dollars. So it's really an interesting subject, and I like to think that a lot of people, when we start talking about taxes and the Income Tax Act, that this is what they sort of see. This is an MC Escher piece, which is sort of an archaic maze of you don't quite know what's up or what's down, or which way to go, or heads or tails, and this sort of thing. And I actually have a copy of my Tax Act here with us today. This is my copy here. Let's make it a little bit bigger maybe for us. Yeah, and so you can see it's it's a massive book. This one here has 2,192 pages. It literally has more than 1 million words, and like the font is really tiny. You can pretty much see through the pages. It's just this huge archaic mess. But when you can go through there and digest it all and make heads or tails of this MC Escher painting, what I really see when I look at the Tax Act is something that looks a little bit more like this. Yeah, like literally a room full of gold. And like there are so many little secrets within the act and the publications that when you can decipher them and apply them to our real estate business, for example, there's a lot of tax savings to be made. I got a great example from a couple of years ago. I had a client of mine who had a house, a two-story home, and attached to the back of the house was this very large open room. And it was sort of like a warehouse, but they had these big canisters. They had a little like manufacturing plant going on back there that was part of the home. And we were trying to figure out how to claim the business use of a home expense against their company. And there's two common approaches that we use to calculate this usually. You can either take the square footage of the business use as compared to the square footage of the entire home and take a percentage based on that. You could, two, count the number of rooms that you use for business, in this case 1, as compared to the number of rooms in the entire home, and use that to calculate a percentage, and that's the way we usually do it. But this person had such a large room, it was like half of the house. But using those two calculation methods, you don't get to 50%. So we found a really interesting piece of case law that said that we could take business use of home expense by calculating the cubic feet of the house. And it's just this really obscure piece of tax law, but in this case we're able to apply it to our client's circumstances, and we're talking about like literally thousands of dollars in tax savings, which is really, really neat and really kind of interesting. And I mean, you can apply that to us and in our own businesses. Like I know the top tax bracket here in Alberta, personally, is I think it's 39% right now, and in Canada it goes as high as in Nova Scotia, which I think hits 50% exactly. So it's pretty high tax brackets. And so if your rate of return on your real estate project was, say, 10%, you're really talking about generating an after-tax rate of return of between 5% and like 6.1%, depending on where in the country you're located, if you're taxed at one of the top tax brackets. Or if you have a 20% return on your project, your after-tax rate of return is really somewhere between like 10 and 12.2% or something like that. So it's, and the worst tax issues that I see are as soon as we start dealing with cross-border real estate, where people will make the mistake of going and setting up a U.S. entity, and if they don't structure it properly, they can run into double taxation issues, where they're paying top tax brackets in the United States and top tax brackets in Canada, so their 20% rate of return ends up being something like 7 or 8%. It's crazy. So you can kind of see that if we can save our taxes, keep more in our pocket. And I mean, number one is always going to be, learn the real estate business, follow what you're passionate about, and make some money doing it. And then number two, as soon as we're starting to make some money, let's see how much of that we can keep in our pockets. So where I'm going with this is taxes are really important. My little Johnny Depp quote: "Not all treasure is silver and gold, mate." We have some very specific
Hello? Chris?
Oh, okay, there we go. I think it says we're back here now. Okay, hopefully we didn't miss anything.
Okay, perfect.
Good. Yeah, important changes that just came out here a couple weeks ago. The government has announced that they want us to start claiming, they want us to specify in our tax returns when we're claiming the principal residence exemption. This is a really important change for us working in the real estate business. Historically, if you we're living in a house for a period of time, you sell it and you move out. If you claim the principal residence exemption and you don't pay any taxes on the capital gains. Most people are fairly familiar and confident with that concept. The government's now requiring us to declare that on our tax returns. There's a fancy form that we need to fill out anytime we sell a principal residence, where we declare which years we're claiming this specific property to be our principal residence. And they're going to start keeping an eye on making sure that taxpayers are doing it properly. And this comes at a time when the government is, you might be familiar with some of the extra taxes that they've been imposing lately on foreigners buying and selling real estate out of Vancouver, right, to try to control the real estate pricing over there. And the government is trying to kind of play off these tax changes around claiming our principal residence exemptions. They're trying to kind of play it off as they're trying to keep foreigners compliant with these tax laws, because they're saying, oh, we have people from overseas who are buying and selling real estate here and claiming the principal resident exemption, and they're arguing that they're trying to keep these people in check. However, I personally, as a tax professional, I've been seeing, good or bad, a lot of people in the business who will, for example, move into a property, renovate it, move out and sell it, and claim the principal residence exemption. And you know, that's all in good, but the government might make the argument that if you're in the business of renovating and selling properties, that you're not allowed to claim the exemption. And so it brings up all these kind of checks and question marks around what we're doing. There's a there's a Supreme Court of Canada case from it was either 2006 or 2009, fairly recent case, where a lady had done just that, where she had bought and sold 7 properties over the course of 6 years and claimed the principal residence exemption in every one of those years. And in taxation, we have something called the adventure or concern in the nature of trade. And you see, what this really means is the government is looking at her buying and selling these properties, and they're asking the question of, okay, are you buying and selling these properties because you're living there and this is your principal residence, or are you really buying and selling these properties because you're in the business of renovating and flipping houses? And the Supreme Court of Canada ruled, like, no, you're in the business of flipping homes and therefore do not qualify for the principal residence exemption. And what ended up happening with this lady was she had to pay back taxes and penalties and interest for not claiming the income on these properties. And so it's a very, very interesting circumstance. And I sort of see that these changes that the government are making right now with claiming our principal residence on our tax returns, I kind of see it as keeping an eye on these sorts of activities. And I wouldn't be surprised if we saw some more reviews and audits of these types of things moving forward. So point of my story is important tax changes starting this year in 2016 and forward. If you've sold a home and want to claim the principal residence exemption, it needs to be claimed on your tax return. Whether you're paying taxes on it or not, you can still take the exemption tax-free if you qualify. We just need to be making sure that it's getting included on your tax return. So kind of neat. We busted that myth. You cannot always flip properties when you're living in them tax-free. Myth busted. So I'm introducing a problem here, and I'm going to talk about some solutions as we move forward and some ideas that we can use as people working in the real estate industry to be saving ourselves some tax dollars. Okay. So here we go. This is you. You're red, and you're pondering, how am I going to do this? What's the best structure? How am I going to keep my taxes down? And if we're in the business of real estate, whether that be building homes or lease to owns or whatever it is that you're doing in real estate, we've seen a lot of interesting models. A lot of people tend to gravitate towards setting themselves up with a corporation. I'm a fan of corporations most of the time. What's kind of nice about corporations, a lot of people are familiar with the idea that when you have active business income in the hands of a company, it's taxed at a much lower rate than your personal tax rates. We were talking earlier about top marginal tax rates in Canada, from Alberta to Nova Scotia. It kind of ranges between 39 to 50%. In a company, if your net income is $500,000 or less, and it's produced from active business income, the tax rate here in Alberta is only 14%. And sort of across the country, we're talking about a range of kind of between 13 and I think about 16% or so. So much lower than our standard personal tax rates. So some people like to set up these companies just for the tax efficiencies of having their taxes taxed as business income inside of a company, which is kind of nice. There's the additional benefits of limited liability protection. Some people like to set up companies because it makes them look a little bit more professional. You know, if you're engaging contractors or you're purchasing a property and you can do up your contract or your offers with like a nice company name on it, that kind of insinuates like, hey, I'm a real estate professional. Maybe people will take you a little bit more seriously. So kind of those add in there as well. But one of the challenges with a model that looks like this, where you have an owner, or you know, maybe it's a husband and wife combo who own a company. One of the challenges is whenever you have what we call passive income taxed in the hands of a corporation. And when I'm talking about passive income in real estate, usually we're talking about rental income. The CRA says that rental income is always passive income inside of a company, but you would also include things like if you have any sorts of interest income or dividends from other companies and that sort of thing. If you do any private lending or mortgages, if you're issuing any mortgages, interest income taxed in the hands of a corporation is taxed as passive income, and passive income taxed in the hands of a corporation is much higher. In Alberta, where I am, the tax rate is 44.67%. Like we're talking like ridiculous tax. Like it just doesn't make any sense. You'd never want to pay taxes at those rates. So I mean, one of the challenges that we see dealing with real estate professionals is people who make the assumption like, oh, I'm buying rental properties, I should make a company, and usually my feedback to them is like, hold on, not so fast. Let's take a look at the taxes. You might be paying 44.67% tax, and you know, we have lots of people who come to us with this model where they have a company that owns some rental properties, and there are things that we can do in this situation to drive down their taxes, and most of the time, actually like none of the time, they end up actually paying 44.67%. Usually we employ some other strategies to get those tax rates down there significantly lower, but if you don't do that, you end up paying like stupid amounts of tax. So it's really important in those situations to kind of think about what you're doing ahead of time. One very common model that we see for people who like to get into generating rental income, for example, in a company, is to set up a slightly more complicated model. And you might have seen this before. It looks something like this, where you actually have you have three companies here. We have up at the top, we have your holding company, and the holding company is owned by you or you and your spouse, or sometimes we put kids on there, or mom and dad if you have parents that you're looking after, or what have you. There's some strategizing and planning to who actually owns the holding company and how those shares are structured. That can be really interesting. But your holding company, the topmost company, the sole purpose of the holding company is just to own your other companies, nothing else. It just owns your other companies. And in this particular example, in this simple example, you have two additional companies. You have what I'm calling here the management company, which is really that's your active business income company. Okay, so that's the company that is paying that kind of 13 to 16% tax. It's 14% tax here in Alberta. We'll put it up there. And then on the right-hand side, we have the property company, or some people call it their real estate company. That's the company that owns your passive assets. Okay, I keep using the example of rental income. It could be if you own mortgages, or this is my exact corporate structure, by the way. Well, not exact. Mine's a little bit more complicated, but this is the general premise behind my corporate structure. And in my property company, I put like some Canadian stocks and exchange-traded funds. I hold some REITs in there. I have some U.S. assets and some real estate, and so it's like it's really like an entity that you can put passive income. So to put it up there, that would normally be taxed at 44.67% if it's things like interest income or rental property income. When you're introducing other types of assets into your property company, like I was talking about, like a really tax efficient passive asset that you can put in here is like Canadian dividend generating stocks, or I like to hold some REITs in there. And dividends from Canadian stocks are super tax efficient in the hands of a company, and same with distributions from a real estate investment trust. Or like if you have like a property that you're just buying to participate in the capital appreciation, that can be really tax effective in this type of company. Like you can just put those types of assets in a passive company like this, and your taxes are going to be really efficient without doing a whole bunch of additional planning. So that's really good. But it's when you're talking about rental income and interest income specifically that we're dealing with these higher taxes. And so there's a couple benefits here to setting up a model that looks like this. And the first one is when you separate your active income from your passive income, we can specify where we're writing off your expenses. Okay, so for example, if you didn't have all three of these companies, if your model just had one corporate entity and you had both active income and passive income going into the same company, let's say that we're going to go and write off some extra expenses against your business, like home office costs, like we were talking about writing off a portion of your home for your business. In that case, if they were both in one company, we would have to apply those expenses against your active income first before we can reduce the net income on your passive income. So like if you have a home office, that's saving you 14% in tax, whereas when we separate them out into different companies, we can choose, okay, we're going to put this expense, or this expense is going to be more heavily weighted towards the passive company for these reasons. You give some reasons, and now we're going to save 45% tax on those expenses, whereas you'd be forced to write them all off against the active income if they were just under one company. So by separating them, we can allocate our expenses between the two companies in a much more efficient manner, which is really neat and really important. The other really cool thing with this model is that we can charge a management fee from the property company to the management company. And you make the argument that the management company has to do some work to manage the property company. It's finding a tenant, it's putting together your lease to own arrangements, it's managing your investment portfolio and reviewing your statements and taking care of the bookkeeping or whatever it is that you have to do. And for these things, we can charge a management fee from the passive company to the active company, okay, which is really cool. And so what we're doing there is we're now taking passive income that if we didn't do anything, we'd be paying 45% tax on, and we're shifting over as much as we can to the 14% tax bracket, which is really, really cool. Really tax. It's a little bit complicated because you got a few companies in here, and there's some extra pieces that you got to put in place, and you got to be mindful about how you're managing your administration and your bank accounts. So there's some thinking that has to go on here. But if we're talking about, if you had $10,000 in net income in your property company, your taxes would be $4,500 roughly. And if we could move all of that over to the active company, your taxes are $1,400. So it's like $3,000 in tax savings, really quick, really easy, so long as you have all the pieces together. And obviously you can see is, if you build up a portfolio of properties, the tax savings build up really, really quickly. So, and by the way, if you're curious, changing from 44.67% tax rate to 14% tax rate is a reduction in taxes of 68.659%. So, Jarek, that's where the title of our presentation came from. But don't worry, I'm not done yet. I got lots of other tips and tricks that we're going to cover. But if we're if you get one takeaway from how we're structuring our real estate, this is kind of a really popular model in the real estate world. So it's kind of interesting to think about and talk about. Once we start playing around with income within our corporate structures, I like to kind of talk about what we call the 3Ds of tax planning. Okay, the 3Ds of tax planning here are deduct, divide, and defer your taxes. And when we're talking about tax planning, this is usually what we do is falling into one of these three categories. So deduct, of course, we want to write off as much as possible against our taxes. By the way, if you have rental properties and you want to kind of get a listing of common expenses, send me an email. I have a handout that I can send you that's got a listing of all the common deductions that you can have against your rental income. Or I have a common handout for business taxes. So if you're like a developer or you're in the flipping business, I've got another handout that I can send you. So send me an email and I'll send you the handout with the common deductions if you like. The second D is divide. Once we start taking our money out of our company, who is paying the taxes? And there's some really neat things that we can do when we start splitting income between, like a husband and wife is a really common example, where we can either just give them the income equally to put the total in the lowest tax bracket, or sometimes we have one spouse who's working and one spouse who isn't working or working less, and we'll maybe allocate a little bit more dividends towards them, or give them a little bit of a management fee to try to take advantage of lower tax brackets, which is really neat and really interesting. And the third D is defer. If we don't have to pay taxes today, why would we do that? And I mean, the whole idea of retaining corporate profits, like profits within your corporation, is really a tax deferral. Because I go back here, when we're paying this 14% tax rate on our active income, like if we took a dividend out from this corporate structure, we would probably, or we might have to pay a little bit of personal taxes to take that money out of the business. But if we're reinvesting our profits, we're really deferring that personal tax bill until the future. And if we can put that as far into the future as possible, or take out just a little bit every year to keep our taxes in a lower tax bracket, that's really neat and really efficient and effective. And I know one of the reasons why I really like this model for myself is, in a lot of senses, this sort of corporate structure has replaced an RSP account or a TFSA account for me. Because, I mean, for me, I'm taking income from my job, my run an accounting firm, and I get paid to my management company, and I have my passive assets that also pay to the management company. And if I don't need to take all that money out to live, if I can reinvest just a little bit of that every year, that's a deferral on my taxes. And I could take that money out maybe in my retirement years when I'm working a little bit less. I'm going to be in a lower tax bracket, and we're just really trying to defer that tax bill as long as possible, which is really, really cool and really interesting. When we start withdrawing money from our company, there's some different strategies that we can employ that can again help us reduce our taxes. And usually, like so far, I've been talking about taking dividends out of our corporation, because that's a really common method. But at the end of the day, what really happens when we start taking money out of a company is a good accountant will look at what are we taking out of the corporation, and how do we need to classify that withdrawal in the most tax-efficient way possible. And it's not always through a dividend. There's lots of different ways that we can classify withdrawals from a company. I'm going to give you a partial list here. The first way is through a wage, or through what we call a payroll withdrawal. And some people, when they set up a company, they immediately defer to payroll, because that's what they're used to. When we go to work, we get issued a T4 slip, and we get a regular paycheck, and we get our CPP and our tax withholdings. And most of the time, we find that taking money out of your corporation through payroll is not a tax-efficient method. I like to think that payroll is how employees take their money. And the government, when they designed the Income Tax Act, they designed it in such a way that the government wants to encourage you to build companies to be as big and successful as possible. Okay, it's good for the economy. It's good for gross domestic product. You're ultimately going to create jobs for other people, which are all fantastic things. And so they give you perks to take money out of your company in a more tax efficient way. This is one of the benefits of being an owner of a corporation. So usually there are instances when wages make sense, but a lot of times we find that they don't make sense. So we start looking at other methods. We've talked a little bit about dividends so far, which are really neat. Interesting fact about dividends is right now, if your only source of income are dividends from your corporation, you can take out somewhere in the $20,000 to $30,000 range, depending on your tax credits and what province you're in. You can take out about $20,000 to $30,000 per year without paying any additional personal taxes on those withdrawals. And what's happening is you get something fancy called the dividend tax credit, which you can combine with your personal tax credit, which everybody gets just for living and breathing here in Canada. You get a little bit of a personal tax credit on your tax return, and when you combine those two tax credits together, it means that you can take out about $20,000 to $30,000 personally, tax-free, if that's your only source of income. So one strategy is if you have a husband and wife who own a company together, and that's what they do, they run the company, you give them each a little bit of a dividend every year, no personal taxes on top of that, and it's just a strategy. Just take advantage of it every year, just because you can. The next common withdrawal method is something called a shareholders loan, which is fancy talk. It's a term from the Income Tax Act, and there's some really interesting things again that we can do with shareholders loans. For example, let's go back to the home office expense. You're going to pay your personal mortgage interest or rent and property taxes and your utilities. You're going to pay a lot of that personally. But if we are claiming a percentage of that as a business expense, because that's where your office is, the way that gets recorded on your corporate records is you would say you have paid these expenses on behalf of the company. Now the company owes you money for paying for those expenses on its behalf. Really cool. Again, this is an opportunity for you to take money out of your corporation completely tax-free, which is really neat. In real estate, we see some really cool shareholder loan accounts where people will transfer like an entire piece of real estate to a company, and all of a sudden the company owes them hundreds of thousands of dollars because that was the equity in the piece of property. And again, that's our opportunity in the future to take that money out of the corporation tax-free. I did something really cool last year, and we've run this strategy with quite a few of our clients over the past few years. But what I did last year was I moved out of my condo and I moved into a new home with my wife, and we started renting out the condo. The first thing I did was I transferred the condo to my investment company. Okay, and I took advantage of the principal residence exemption, right? So there was no taxes to transfer the property, right? Because it was my principal residence.
Chris, we're losing connection, is it? Guys, can you confirm that you can hear Chris?
The future. So again, that's really cool, really interesting. We can even do things like, we've had situations where somebody has been renting out a piece of property that they've owned personally for a long time, and maybe if the real estate markets go down a little bit, that could be an opportunity to sell a piece of real estate to a company and lock in a new adjusted cost base for the property. Hello?
Sorry, Chris.
Did I cut out?
1 minute 30 seconds ago, I didn't want to disturb you. However, you were cut off for 15-20 seconds.
Oh no, that's terrible.
What we have heard last, that you moved with your wife and you rented out the
Oh,
conto,
okay.
and you transferred. So would you mind just repeating that if you do not mind?
Sure. Okay, great. We're on now still. Hey, people can hear me?
Yes.
Great. Okay, awesome. So yeah, I was saying that I did something really, really cool last year. I moved from my apartment into a new home with my wife, and we started renting out the apartment. And at that time, we transferred our property to our investment company. And we got to take advantage of the principal residence exemption. So we changed the tax base, the adjusted cost base of the property to the fair market value at the time of the transfer, and we didn't have to pay any taxes because it was our principal residence. And now the rental property is in our investment company, which is where we want it to be because we can take out our passive. We're transferring our management fee and we're converting it over to a lower tax rate, which is nice. But the really, really cool thing about the strategy is now the company owes us a bunch of money because we gave it a piece of real estate. And so that's an opportunity that we can use into the future to take money out of our corporation tax-free, which is really quite neat and quite interesting. We have some other clients who do things where, if they see the real estate markets come down a little bit, they might sell a piece of real estate from their personal name to their investment company to, take advantage of a loss or just move it over because the markets are a little bit lower and that's a good time to move it into an investment company. And it's just an interesting strategy because you can take money out on a tax-free basis. And the last withdrawal strategy that I'm going to talk on today is something called like a health plan. I usually use medallionhealth.ca. They're a small Calgary-based organization, but what's really interesting about using a strategy like this is let's say that you go to the dentist or you take your family to the dentist, right? You pay to have your teeth cleaned, and whatever it's being, a few $100 a person, or $1,000 for the family, or something like that. And if you want to write that expense off against a business, you can't normally do that. It needs to be processed by a third-party provider. And so again, we use Medallion Health, and what really happens when we do this is it allows us to take the expense, our dental expense, and write it off as an expense against the company, which is good because we're saving 14% tax or 44.5% tax, depending on your tax bracket. But two, it also allows you to take that money out of the corporation again on a tax-free basis. So, I mean, anybody who's got even just a little bit of medical, dental, chiropractic, if you got some prescription drugs, I usually like to recommend a strategy like this. There aren't any monthly fees or anything. It's just you're just submitting your claim, and like you still have to pay to go to the dentist. Don't get me wrong, but at least you can take the tax write-off and take the money out of the company again on a tax-free basis, which is really kind of cool. So I've got just another slide or two here left, and then I'm going to wrap up. So if you want to put together a three-tier corporate structure like we've been talking about here, there's kind of a few things that need to happen. First of all, you need to set up your corporate registrations. You need to register your company in whatever province it needs to be registered in. And by the way, I know there's a lot of we help people through this process. If you want somebody to give you a hand, there's a lot of lawyers that'll set up these for you. I tend to find that they're a little bit more expensive than I personally like to pay myself, but they're not that hard. I'm going to just kind of give you a few of the pieces. You need to register your company in whatever province you're going to conduct business with. You need to create the full minute books, which includes, this is really important, your securities ledgers need to represent the corporate structure appropriately as we've discussed. And we're talking about who owns your holding company. If it's a husband and wife, you want to set up the share structure appropriately. A lot of times we even like to throw in, some kids in there for income splitting purposes. Or I have some clients who are taking care of one of their older parents, and we'll just issue them shares in the company because it gives us a neat opportunity to give your parents a little bit of income. If you're going to give them some income anyways, we might as well give them some dividends, and they can pay a little bit of taxes on it and take advantage of lower tax brackets. So security ledgers are a very important part of setting up the structure. And of course, you need a management agreement between the passive company and the active company that's going to represent how we're going to transfer those management fees over. So really cool to get all these pieces together. And there's one more really important thing that you might like if you're going to set up a structure like this, and that is a good accountant. There it is. Good. So with that, I'd like to thank you for having me here today. My email address is on the bottom of the screen. And if anybody has any questions about real estate tax or any of the ideas I've gone over a little bit with you today, I'm ready to see if I can help you out.
I'm already on that website, Medallion Health, and then there is your feedback about their services, right? Hello?
Hello?
Can you hear me?
Yeah.
Yeah, I'm sorry.
No,
I want to just make sure. And
yeah,
I'm on the eligible expenses. There's a lot of nice expenses like air conditioner, air filters, right? Animals expenses, attendant cares, blah, you know.
Yeah.
There is a lot of things which you can implement.
Right.
I'll definitely have a look on that, right? So guys, do you have any other questions, guys? I guess there is today very quiet.
I must have answered them all throughout the presentation.
Definitely, definitely. So, do you know anything out of about investors who are in BC? Can you elaborate more about the implementation and consequences of what changes which they are just introduced recently?
Yeah, you mean for the like the change, like the specifically for foreigners investing?
Foreign investors, right? Yes.
Yeah. Well, I don't know exactly what the rate is, but I mean they're charging additional taxes on the purchase and sale of real estate out there. So I think the intention is to try to not let the real estate pricing get too out of hand out there, because you're living in downtown Vancouver, and I think the prices are just going up quite a bit. So I think they're just trying to make things a little bit more affordable for the locals.
Okay, perfect. Guys, any questions?
If you do have some questions, please just send me an email. I'm always happy to chat with members of the group down there, either myself or a member from the team I was showing you in the photos earlier there.
Definitely. So, Chris, we would like to thank you very much for the presentation. If anybody wants to watch again, it will be available within 48 hours. And we have Mr. Rajan. Okay, just give me a second. Hello, Mr. Rajan. Can you unmute yourself? If you are on the laptop, definitely you have a mic. However, I'm going to read it for you, Chris. Hello, Chris. Can you elaborate on the charging management fee to your holding co? I have never paid real estate taxes, as a net income is usually 4-5%, and annual depreciation is 4% annually.
Yeah. So great question. Let me take. I'm gonna take the annual depreciation bit first. I'm just gonna go off on your question a little bit, and then I'm gonna come back to the management fee thing. Okay? Because the whole topic of taking depreciation on your real estate is a really important consideration. First of all, there's pros and cons to that, and it's always worth taking a look at. Because on the plus side, you're right. If you're depreciating your property, you can take 4% of the remaining value of the property every year, except for the year of acquisition. And for a lot of people, that's enough to reduce the taxes on their rental income. We see a lot of clients where it eliminates it completely, but some of the clients who start to pay off their mortgages, we find that even when you're paying off even if you're depreciating, we still see people who have tax ramifications from those changes. The downside to taking that depreciation is that when you go to sell the property, you're going to have an increased tax bill at the time of sale. Okay? And so with our clients, it's always sort of a mixed bag. Some of them we depreciate, and some of them we don't depreciate, and we usually take it on a case-by-case basis. I have one particular client who has a handful of properties, and she'd never depreciated any of them. But we started looking at her situation and her tax brackets, and we realized, like, hey, this woman's going to have these properties forever. She has no intentions on selling them anytime soon. And we decided to double back. And this was like when we first started working with her. So we were going back and changing another accountant's work. But we went back and we went back, in her case, 4 or 5 years and depreciated all the properties after the fact, after the filings were done. And this woman, it got her a $12,000 refund. And she was so excited. She said to me, she's like, Chris, I just about fell out of my chair. I was so excited with the refund. So that was kind of cool. But when we're back to your question, when we have your passive company, we're booking the management fee over to the active company. You need to justify the management fee. Okay. Some people have tried to just book a management fee in whatever the net profit is, and that doesn't work because there's no justification to the fee. You risk exposing yourself to having the CRA come back and look at what you're doing and saying, like, no, this management fee isn't reasonable. This is just a number you made up, or this number is way too big. So you need to create an argument that makes a system out of the management fee. So usually what we're doing is we're doing a management fee for 10 or 15% of gross rents, because that's typically what a property manager would charge. Or when we start dealing with stock and investment holdings, we might take 1 to 1.5% of the value of the portfolio, because that's what a typical portfolio manager would charge. So you need to sort of justify it somehow. But if you're in a situation where you're like, well, I'm not really paying much taxes anyways, or I'm not paying any taxes anyways because I'm taking the depreciation every year, you might make the argument like, no, it doesn't make sense to take the management fee. But if you did decide to take the management fee, like a strategy could be to take no depreciation or take less depreciation and take the management fee instead. And what you'd be doing there is you'd be paying some taxes today because you're going to pay taxes on the management fee. But at the time that you eventually go to sell the property, you're not going to have to pay the extra taxes because you haven't taken as much depreciation. Does that help?
Definitely.
Interesting. I know you don't have your mic on, but hopefully you found that helpful.
Yes, and then approximate cost for your firm to set up the accounting method annually.
Sorry, it's the question on how to the cost to handle the annual tax filings. Is that the question, or the cost to set up the structure?
Yes. Yes.
Yes to both.
Yes.
Yeah. We set up corporate structures like the one I described. We have a standard fixed rate. Usually it's $895 per company. That typically applies to an Alberta corporation, and the price will fluctuate depending on which province you're in. We also set up a lot of cross-border structures where we're setting up U.S. LLCs and LPs, and the cost of those are just a little bit more expensive because the cost to register them is a little bit higher. So there's a little bit of a variance, but it's we usually find it to be much cheaper than using a lawyer, which is nice. But not that I'm trying to price compete with the lawyers. I'm trying to compete by providing a fantastic service, but we happen to also be a little bit more cost effective. Our corporate tax preparation fees vary depending on the size and complexity of a particular company. Okay, so assuming that your bookkeeping is in order, and you're an organized person, and you got some nice spreadsheets and things like that, and your paperwork is pristine. Assuming we don't have to do any bookkeeping, corporate tax preparation ranges from, on the low end, about $400 to we kind of max out at $1,590 for a standard Canadian corporation. And then when we have multiple companies, if we have 3 companies or more, usually we do a little bit of a discount because it's just more efficient to do lots of filings all at once for multiple companies, because you're not having to deal with as many people and things like that.
Perfect. Now we have a Tracy, and then we have another question, follow-up question. So
okay.
If you do not mind, I'm going to unmute Tracy. Hey, Tracy.
Hi, Tracy.
Long time no see. Yeah?
Chris. My question is, so would you recommend doing private lending, for example, investing in second mortgages through your real estate company as opposed to your management company?
Yes, absolutely. If what you're getting from your private mortgages are interest income, that should be booked to your property company. But some people will charge like a lending fee, which is arguably active business income, and you would want to book that to your active company. Okay. And there's even an argument to say, like we have some clients. For example, I have a client who has a little investment portfolio that includes some private loans and some real estate, etc. And they put a lot of it in one company, and then they have like a whole apartment building. And we happen to put that whole apartment building in a separate company. So like this particular client actually has 2 passive companies, and the only benefit there is really to kind of separate the assets. Where I don't know what your private lending and stuff looks like exactly. Some people get concerned about maybe not so much in the private lending. Some people get concerned about if the activities that they engage in, if they're ever going to get sued as a result of what they're doing. And so there's an argument to say, oh, we should make a couple companies if you have lots of assets, just to keep them separate for liability purposes. But yeah, interest income from private lending should be booked to your passive company.
Okay, great. Thank you.
You're welcome.
So Tracy, you are muted, and then Mr. Rajan again. So I'm going to read it. Since you see objective real estate returns from many intelligent real estate investors without all the BS, where do you see the best POST, post-tax returns? I find great accountants are able to guide me to the best area, smiley.
Sorry, can we repeat the question one more time?
It's more likely, since you see objective real estate returns from many intelligent real estate investors without all the BS, okay? So he's complimenting you, Rajan, right?
Thank you,
Where
Rajan.
do you see the best post-tax returns?
The best.
I find great accountants are able to guide me the best areas.
Like the best places to invest money?
Yes.
Yeah. I know we've been seeing a lot more, especially the last couple years, of people going across the border. Okay. And I personally, I have quite a few pieces of real estate down in Texas myself. We just have some simple buy and holds, just rental properties down in Texas. So I like some of the southern states, because the rate of return on your rental income as compared to the cost of the property, I find it to be quite a bit better than what we're getting up here in Canada. So the stuff we're buying down in Texas, we're getting cap rates of 11 or 12% in major metropolitan areas with strong economy. We're not buying out in the boonies, like we're buying like in Dallas, in Houston. So we're seeing that the rates of returns in those types of areas are pretty good. Some of the challenges that I see, well, with something like that, first of all, with going across the border, there's a lot of extra complications in dealing with the cross-border taxes, because usually we're dealing with more complicated structures. So the administration and the filings, like it's a little bit more burdensome. So the best success that I've seen in those types of areas have been, where people can pull, a little bit more money together, where you get like a son and dad together, and they're like, okay, we're going to pool some resources, and let's get Uncle Nick involved, and all of a sudden you've got an entity that's got, enough capital that they can, go down and do something with, and they're all on the same page. We don't have multiple people, each with their own entities, because that just makes things confusing and complicated. So, if you can have like one unified vision, get a little bit more capital together, and venture down to the U.S., it becomes a little bit more like you're taking advantage of economies of scale, just because it's a little bit more expensive and a little bit more complicated to make something like that happen. But where I see some of the other like shortcomings that we see in real estate right now are people. Some of our clients, participate in, things that I'd call like some riskier areas of real estate, where they don't quite put together like a rent-to-own arrangement properly, and they end up getting some lawsuits and stuff like that down the pipe, or we sometimes see people who go and develop a piece of real estate, and they end up spending a lot more than they can sell the property for, and that sort of thing. So. But some of those areas, like we're talking about areas that you could make potentially a lot more money in real estate, but maybe the risk is a little bit higher. So maybe that's maybe we see the people who aren't quite successful in those areas. So I guess my personal opinion, and I guess this is just personal. I know lots of people would disagree with me, but I try to keep things a little bit more conservative when I participate in real estate. So I'm about not taking on too much leverage, keeping things really simple and easy to administer, and in exchange, we're talking about lower rates of return for something like that. But personally, it just makes me a little bit more comfortable. So I guess it comes down to personal preference and how much risk you want to take on for the money you want to make.
Yeah, so it looks like you're older guy, but you're not so old. Because by my experience, I noticed young guys are very aggressive. They want to make money now, right away, and older, more, experienced people, they're looking for, stable ROI, etc., right? So
Sure.
that's my personal opinion. I'm very, very cautious about that, right? So, Rajan, yes, there are some questions, follow-up questions, where you were investing, etc., but I see that you are answered. So any other questions, guys? So we have a contact information for Mr. Chris, pinnacleaccounting.ca, Chris Burylo, pinnacleequities.ca. Please mark it down, and we have a kind of business relationship with Mr. Chris and his company. So Canada Real Estate Investors Club members, they have a special treatment and discounts. So I would like to mention that, and I'm going to switch information, if that's okay, Chris, to my PowerPoint presentation, if you do not mind.
Great.
Just only for. Okay, the information is, if you wanna find out about our membership, our informations, there are the website, contact information, cell phone numbers, etc. I would like to thank everybody, Mr. Chris, as always, pleasure, and we will be thinking about running live event within a couple months, more likely. Maybe January, February, we will see it. So you are more than welcome to join us, and we will be doing live broadcast. So anyone in entire Canada or US, and we have even some members from China, if you can imagine, right? Canadian investors from China. So thank you very much, Mr. Chris. Any other questions? You're most welcome. Thank you, guys.
Thanks, Jarek.